Good afternoon, everyone. Thank you for joining this virtual discussion regarding Illinois' new Community Reinvestment Act. My name is Mario Trotto Jr. I'm the Acting Secretary at the Illinois Department of Financial and Professional Regulation. On March 23rd, Illinois became the first state in the Midwest to have a CRA become law. Illinois is also the second state in the country that includes non-bank mortgage lenders and the third state that includes credit unions being subject to state CRA compliance. We're pleased and honored to have regulators from Massachusetts join us for today's discussion. As you might know, Massachusetts was the first state in the country to include both non-bank mortgage lending and credit unions in its state CRA. Joining us today to explain the Massachusetts CRA are Mayte Rivera, Deputy Commissioner of the Massachusetts Division of Banks. Her responsibilities include management and policy oversight of consumer compliance, the Community Reinvestment Act, and fair lending examinations, as well as spearheading outreach and special funding and grant initiatives for the division. In 2018, she created and launched a new online webcast program at the division, DOB Connects, which has become a popular outreach and virtual communication vehicle for banking regulators, financial industry, and community stakeholders with over 1,000 attendees since its inception. We also have Kevin Cuff, a Deputy Commissioner serving the Division of Banks Non-depository Supervision section. He is responsible for oversight of mortgage supervision, examination, and licensing, and has a 25-year career in financial services, risk management, and compliance. He has served the Massachusetts Mortgage Bankers Association, the Community Mortgage Lenders of America, and the Professional Risk Managers International Association as Executive Director. Here to explain what's next for the Illinois CRA are Francisco Menchaca, our Director of the Division of Financial Institutions, a role he was appointed to by the governor in 2013. Prior to that, he served the department as the Credit Union Supervisor from October 2012 to his appointment as the DFI Director. And prior to joining the state of Illinois, he spent more than 20 years in the banking and the financial services industry, notably serving as a vice president at JP Morgan Chase before he served at the Federal Deposit Insurance Corporation, FDIC. Francisco is a proponent of robust public-private partnerships, entrepreneurship, and community economic development. And last but not least, we have Chasse Rehwinkel, our acting director of the Division of Banking since June 2019. Prior to his appointments, he served as the chief economist and director of the bond division for the Illinois Office of the Comptroller. He has also counseled the comptroller on a number of boards and commissions and served as the director of policy for the Illinois State Treasurer, where he oversaw the creation of the National Able Alliance, a coalition of 16 different state governments that created a set of affordable savings programs for people with disabilities. We're excited here for the next chapter in Illinois to incentivize more safe lending into low and moderate income communities. Here to get things started is Chasse Rehwinkel, our acting director of the Division of Banks. Chasse.
Thank you so much, Secretary, and I very much appreciate your kind introduction there, and we're all very excited to get this started. So I know there are a lot of folks on this call right now, and there's from a lot of different walks of life. We have folks that are interested on the advocacy side. We have banks and credit unions and non-bank mortgage lenders. And we're really excited to dive in. What I wanted to reiterate up top before we got into the discussion point is this is the first of what will be a series of conversations on the state CRA. The Secretary's desire here, as well as everybody at our agency, is to have an open and transparent process in this, which will be one of the largest projects that this agency has undertaken since its creation. We want to make sure that we're soliciting feedback from all areas of the state so we build the strongest program forward and that we can adjust it over time as we see fit. The legislature has tasked us with an incredible responsibility to make sure that we're doing what's right for both Illinois consumers and the industry as we get this going. So at the end, we'll have a discussion about further events as well as Q&A and written comments in those periods as we work toward the timeline for implementation. With that, I wanted to start with a conversation from our friends in Massachusetts, and we wanted to have this discussion with Massachusetts because they have such a strong expertise in this area and has been giving a lot of guidance, not just to us, but to other states over the years on state CRA. So with that, I wanted to kind of turn it over to our friends from Massachusetts to kind of give an overview on how Massachusetts banking looks and what their general duties and responsibilities are.
I'll start that part of the conversation, Chase, Mr. Secretary, and good afternoon, Illinois. On behalf of Mayte, thank you very much for having us. This is a treat for us, and it's great to sort of share with you some of our insight and some of our experiences over the last many years dealing with CRA and implementing its the policies and the programs that affect it. So thank you very much for having us. What I thought I might do is just touch upon a little bit the history of banking and bank regulation in the Commonwealth of Massachusetts. Then I'm going to pull up a slide that's just a sort of an outline of all of the institutions in which we have under supervision. And I'll make a couple of comments. Mayte will correct me where I'm wrong, and we'll make our way through this. But banking and bank regulation in Massachusetts traces itself back to February 7th, 1784, when state law signed into incorporation the bank and created the Bank of Massachusetts, which at the time was the first state chartered bank in the nation, the second bank created in the nation to the national bank. And the charter was signed by Governor John Hancock and Senate President Samuel Adams. So long before Samuel Adams was a really good beer maker, he happened to be the president of the Senate. And also the charter sits in our Pierre J. conference room, in which we affectionately refer to seeing John Hancock apply his John Hancock to the charter. The charter itself contained a provision that required bank examination, so hence the creation of the first bank also created the Massachusetts Division of Banks, and we've been here ever since. So Massachusetts has been the first in a handful of things, as I just outlined. Also, in 1966, under the leadership of then Commissioner John Hines, who later became the mayor of Boston, the Commonwealth passed the first of the nation truth in lending law. It also created anti-redlining law as a result of activities that were going on in the city of Boston with a nationally recognized bank at the time, which was the First National Bank of Boston, which had been around for 150 years. So I know Chicago, in the south side of Chicago, has some of the earliest anti-redlining law that was ever created. Likewise, in Boston has likewise legislation that dates back to its very early beginnings in anti-redlining. Another element in that 1966 that was a first in the nation was beyond creating the anti-redlining statute, was also granting the ability to have mortgage loans subject to the review of a mortgage review board, which was the creation of 4 mortgage review boards, which I oversee today, which allows any consumer in the Commonwealth of Massachusetts who believes that they have been discriminated or denied access to a loan because of the location of the property, you can file an appeal through the Mortgage Review Board, which meets quarterly, as it does today. I'm going to pull up today where we sit today. If I can share this document, bear with me, please, for just a second. So I don't know whether this is going to allow me to share this. I don't think it's going to. All right. This is just a, it is a what we call a division at a glance that we release on a monthly basis. It's attached to our website. It allows the consumers in Massachusetts to sort of get an annual report of all of the financial institutions in the Commonwealth that are under supervision by the division. So in Mayte section, the depository institution supervision, there are 156 total depository institutions, 57 of which are credit unions, 33 are cooperative banks, 49 are savings banks. There are a total of 1,319 branches and a total asset under supervision of $514 billion. Mayte, anything to add to that general overview for depository supervision?
No, I think you covered it well. And again, that's available on the homepage of the division if anyone is ever interested in looking at it.
In non-depository supervision, we have that broken up into mortgage lenders and brokers, as well as money service businesses and consumer finance. So there are 254 lender companies, 365 mortgage broker companies. There are 11,800 mortgage loan originators. There are a handful of consumer finance and money service businesses. There are debt collectors and loan servicers, 429 debt collectors, 113 loan services. So the total non-depository licensees under supervision at the Division of Banks are 13,259 licenses. So that gives you a general idea of what the Massachusetts Division of Banks has by way of a supervision authority within the Commonwealth today. I hope that that was a good start to the conversation, Chasse.
Yes, and I'll and for people that want to see that document, we can certainly send it around as well.
Yes, I'll make that available.
So we'll switch over to the next question then. Yeah.
That's for me. That's all I have right now on my.
Yeah, I think Francisco, you're muted.
Sorry.
Sorry.
Yeah.
Yes, thanks very much. Thanks very much, Kevin. Hi, this is Francisco Menchaca. I am the Director for the Division of Financial Institutions. And let me also take the opportunity to welcome you. We're pleased that you are joining us today. This is the kind of the first of a number of events that we have planned to try and make sure that we provide communication, but also some cooperative nature and transparency in what we're trying to do here, because this is such a historical movement in moving forward in implementing the CRA here in the state of Illinois. So, Kevin, that was very informative. I really appreciate what you shared with us. A lot of similarities in the types and the businesses that you have there and what we have here in Illinois. And what we're talking about today specifically is about CRA. So I was very interested to hear the fact that Massachusetts had the first bank in the country, but also a number of, you have these 4 boards that take a look at like mortgage boards that oversee the mortgage reviews. So that was very interesting. I haven't heard that before. But since we're talking about CRA today, I think I'd like to ask either you, Kevin, or Mayte to talk to us a little bit about the history of the Massachusetts CRA, how it got started, and where you are today.
Excellent. And thank you, Francisco and Chasse and Secretary, for, again, this great opportunity. We are always interested in working together with one of our state counterparts. So as Kevin mentioned, the division has oversight of various depository institutions. And the state charter depository framework of oversee, the CRA aspect of it really got started in 1982. And that was as a result of the first law that was enacted back in the 1980s, early 1980s. As a result of the statute, obviously the institutions that were already subject to the federal CRA also for that particular aspect of the industry, it was not anything really new, but it was new in terms of the fact that Massachusetts was also going to be adopting a similar CRA responsibilities. You probably know that in 1977, the federal statute kicked in. And again, the Massachusetts one really became part of those requirements over credit unions and also including the banks, state charter banks, in 1982. And as Kevin mentioned too, this was a initiative largely due to the fact to counteract redlining practices by institutions, the banks back then that were being looked into the umbrella of the federal CRA as well as fair lending requirements. There was a lot of discussion about that during that space of time. and Massachusetts adopted a similar framework. In that period of time, we incorporated during the early 80s rulemaking. We embarked on the rulemaking process and examination procedures. And so it was a very busy year. I was not at the Division of Banks at that point in time. But I know that there are folks within the legal unit that do recall and have a lot of information in their archives. It's very fascinating to look at that information. So as mentioned, the CRA in the 80s applied to our state charter financial institutions, including credit unions. And, a lot of the discussion was about, in that point in time, how would we going to apply the CRA to the credit union industry, given the fact that the structure of the membership was, and it is somewhat obviously, unfeasible to look at it in all the different aspects of the CRA exam. During that rulemaking process, it was determined that the income aspect of the members would be evaluated for the CRA framework, under the CRA framework for credit unions. And then geography would not be adopted. That part of the exam that's part of the depository banking side would not transfer over. So within our regulation, from back in the early 80s, it was determined that only the income aspect of the members would be evaluated to ensure that the buckets of low moderate income would be incorporated in the CRA credit union examination process. Back in the earlier times, CRA times for Massachusetts, there were 12 individual assessment factors. And so very different than what we have today. And at that point in time, it was also required that a CRA rating and evaluations had to be publicly disclosed. In '95, a final rule at the federal level revised the CRA and adopted the current three-pronged performance evaluation schemes that you have today. So we went from having 12 individual assessment factors to the three-pronged performance evaluation schemes that we have today. In '96, we amended the Massachusetts original provisions and ensure that there was alignment between the federal and the state provisions to ensure that the industry would be able to efficiently comply to CRA on both the federal and the state side. So again, that was in 1996. So at the point where the community reinvestment really was established, and as we kept going further and forward through the various decades, the objective, of course, is to ensure that we can assess through our financial institutions the record of meeting the needs of community, especially low income less than 50% of median, moderate income 50% to 80% of median income. This is extremely important in neighborhoods where these concentrations of underserved individuals and homeowners as well as borrowers reside. So the goal and framework of the Massachusetts CRA is aligned and mirrors that of the federal side, again, specifically looking at the income impact and making sure that credit distribution is distributed equally among the low moderate income categories. Lastly, as we have within our regulation, we are always cognizant that every institution is different. So we always include the caveat that it has to be consistent with safe and sound operation of the financial institutions. We understand that financial institutions face a number of obviously financial and economic challenges, and we would never require an individual institution or institutions to do anything that would compromise the safety and soundness of its operation. So that's also within our regulation and statute, and it's important to also reference. I hope that gives you an overall of the CRA history within Massachusetts.
Why don't I talk a little bit about the non-depository side, and I'll sort of address as Mayte did in some degree of a chronological order, at least as I have either studied it or I lived it or I recall as best as I can dating back. But in Massachusetts in the mid 1990s, housing advocates and consumer advocates group partnered with a professor at UMass Boston professor and produced a document called Changing Patterns, which was a collection of lending data throughout the Commonwealth of Massachusetts that they continued to produce and still produce today. So I believe it began somewhere in the mid 1990s, and it showed denial rates, and it showed lending penetration by bank and non-bank lenders in low to moderate income census tracts. And the report was eye-opening. It was glaring. It was accurate, and it created a groundswell amongst the advocacy community that from 1999 to 2006, they filed standalone legislation that would call for CRA-like requirements of non-depository mortgage lenders. Year after year, the industry group in lending, the non-depository lending industry, was able to beat back that legislation primarily on the argument, the traditional argument, that mortgage lenders don't act like banks in the depository sense and therefore couldn't turn around and lend in the same depository sense into a MSA assessment area like depositories do. And they were successful at that until when we got into the mid-2000 financial and foreclosure crisis, and everything broke loose. So in 2006, there was a major bill, an omnibus bill that was passed in 2007 called Chapter 206 of the Acts of 2007. And this primarily was addressed to deal with the foreclosure and the predatory lending practices leading up to the mid-2000 financial crisis and collapse. Now, I don't want to bore you to go off script by way of CRA, but this omnibus bill tackled a lot of elements, including emergency regulation to expand prohibitive acts and practices, to adopt non-traditional mortgage guidance, to license mortgage loan originators, to increase their experience and education requirements, to increase the net worth and bonding requirements of mortgage brokers and lenders, as well as to award grant support for counseling and foreclosure mitigation efforts, which the Division of Banks oversees today, creates a foreclosure database for all foreclosing properties in the Commonwealth that the Massachusetts Division of Banks oversees today. And in addition, it created, as a portion of that omnibus bill, the extension of CRA requirements to mortgage lenders. So Chapter 206 amended Mass General Law Chapter 255E, which is the licensing of certain mortgage lenders and brokers. It is our guidebook on mortgage lending and brokering. There is a component, Section 8 of that calls for continued Community Reinvestment Act requirements to license mortgage lenders who originate 50 or more mortgage loans a year in the Commonwealth. Thus, at that time, Massachusetts became the first state in the nation to extend CRA to non-bank lenders, and it also required the division to conduct public examinations of mortgage lenders to determine the record of their meeting the credit needs of the communities in which they serve. The first examinations of CRA for mortgage lenders began around early 2009. Now, there are some differences. The primary major difference between the evaluation of the two, depository and non-depository, is that the non-depository does not have a defined assessment area. The Commonwealth of Massachusetts, all 351 cities and towns, and the 6.25 million residents of the Commonwealth fall within the assessment area. So if I'm a non-depository lender and I create a program designed to CRA, I don't need to just look within my assessment area or maintain that ratio of inside and outside the assessment area. The entire Commonwealth is the assessment area. In addition, in 2008, the division promulgated regulation of 209 CMR 54, which essentially is the guidebook or the goalposts around the legislation. It sets up, you know, the purpose and the scope. It defines all the terms. It outlines the performance test, the lending test, the service test. It designates the assigned ratings, determines that they're public documentation. There's data collection and reporting. There is publication of the exam schedule and a definition of all the ratings. And we live under that by today, since 2009 until today in 2021. Mayte oversees the depository CRA evaluation process, and I oversee the non-depository, what we call MLCI, Mortgage Lenders Community Investment, which is CRA for non-depository mortgage lenders.
Great. Thank you so much, Kevin and Mayte, on that background. I think you know, with some, that kind of leads us into, maybe Mayte, you can take the start of, can you just explain the process for a bank in the state? Like, how does the state go through the CRA, and then we can go through how that's different with either credit unions or the same, and then we can go to the non-bank, which is obviously even more different from there, if we want to start.
Sure, Chasse. So the full authority and the regulation under Massachusetts that supervises and requires CRA over banks and credit unions is 209 CMR 46. And that's really helpful because it really provides the industry and for us as regulators the framework on how this you know, CRA is applied for our institutions. It applies to, on the bank side, you know, like just like the federal side, small institutions, intermediate, small, and large institutions. And this applies across both the bank side as well as the credit union side. And these thresholds on the asset sides are issued by the FFIC annually, so everyone can see. And again, they mirror the federal side for consistency. When we conduct our exams on the banking side as well as on the credit union side, well, let me focus on the banking side. We interact, and I know that's coming a little later, with our federal partners. When we have to schedule our exams, we engage the FDIC or the Federal Reserve. But that's really critical because if it's a small institution, we will apply just the lending test will be applied. They're only subject to the lending test. There's not a community development test. And if the institution wishes to provide information on community development and services, then those are looked in as well to provide an enhanced rating. And what that means is, based on the regulation, is an institution can receive a higher rating if it documents these additional activities that are part of the intermediate, small, or the large exam. But they're not required for small institutions. And I think that's something that is always a sensitivity, is sensitive to the size of the institutions. You know, I have to say though, for our institutions, Chasse, many of our exams are definitely showing the proactiveness of our CRA activities by our institutions and community banks and credit unions. So there's always additional information and documentation that are provided because they are doing great work within their communities and they receive the credit for that. We provide, there's a lot of interaction on the assessment area component. Our institutions on the bank side, based on the branch location or where ATMs are located, they indicate to the examiners how they want to delineate their assessment area. It is something that is really determined by the institution. The regulators do not impose the assessment area. That's something that needs to be delineated by the institution itself, just again, like the federal side. And on the credit union side, it's really about membership. It is about, how the membership is structured, if it's an industrial credit union versus not, if it's a community charter credit union. There's different nuances that would be taken into account, but all of that is explained to the examiner, and the examiner adjusts the credit union's examination process based on the feedback that's provided. One piece that's sometimes overlooked by industry is that we have performance context, and it's part of the regulation, it's part of the requirements on both the federal and the state side. And that means that given the circumstances and the business nature of that institution, there may be a reason why the performance may not be as high as the peers, because you are compared to peers, to your peers as a credit union or as a bank. If the performance on the lending side is slightly lower than where the performance should be, there may be mitigating factors that are provided to the examiners, and that information is often included within the performance context of the examination. If there are certain circumstances that can explain that. There's also times when perhaps the lending is not, at a satisfactory level or at a high satisfactory level. However, there's financial literacy or homeownership classes that on the service side that the institutions are delivering, and that it's also mitigating some of the performance, because you can see that there's outreach contributions being made to help in mitigate the lending performance. The majority of our exams result in satisfactory, but again, there's a lot of work that's done by our community institutions, community financial institutions, to do outreach and community development, and that's something I really want to underscore during today's program.
That's great. I think before we get to Kevin, just because I know that this is probably going to come up, is you talked about how there's like a different threshold in size. Could you go into a little more like what that difference is, like what the specific difference is, if you have it? If not, we could get it, afterwards. And then I know that, Kevin, it's probably going to be a similar thing to lead into you before your conversation on the originations and what that means for those entities on size.
So the asset size, they do vary. So I would encourage to get the actual asset size and thresholds through the FFIC. But the components of the exam are quite significantly different from a small institution to an intermediate small. And you have to show that through obviously the asset size is what drives that. And the concentration for a small CRA exam is really lending. Lending will drive that exam. So it would then determine whether or not those low moderate income categories within the assessment area were met, and whether the other similar situated small institutions, banks or credit unions fell within that same range of lending performance for low moderate income. The middle income and higher income categories, that will not be included in the lending test, but there is an aspect of our lending test that also looks at how much credit was distributed within the assessment area. There are times when we have institutions that they have 90% of their lending within their assessment area, and this is all part of the lending test, and 10% is outside. So that means that they're pulling borrowers of low moderate income category from other outside of their assessment area, or pulling borrowers outside of their assessment area by 10%, whereas 90% is really concentrated within their assessment area. These are ratios that are looked at by examiners to make sure that the credit distribution is where it should be. If 90% is inside the assessment area, that really works for the institution, and it boosts the lending test component as well as the performance in providing actual loans to low moderate income borrowers.
Great. Thank you. And then if we might want to turn to Kevin to kind of describe the process from the non-bank side.
So essentially, those that qualify are those that have originated 50 or more mortgage loans in a calendar year. So there is an annual review of who meets that criteria. And although you may think that, geez, that wouldn't move all that often, there are times in which there are qualifications within MLCI and those times that they fall out of MLCI. So on a quarterly basis, we publish the schedule of when our exams are going to be or who will fall under those exams by a quarterly basis. We consistently have to go back and check origination volume to make sure that every one that we have a public schedule to go in for an examination meet the criteria to do that. All of the examination, and until a couple of years ago, all of our 3 primary MLCI examiners have all been trained and worked with Mayte in her section before they migrated over to the non-depository section. They all follow the federal guidelines of the examination. There is not entirely, there's no different strategy that goes into a non-depository examination and a depository examination, other than the main one being that the assessment area is significantly different. The testing is the same. The ratings are the same. The tolerances essentially are the same. As we got going early on, we consistently ran into difficulty with the tracking of HMDA LAR data and the quality of that data for many mortgage lenders. So beginning in 2009, I'm going to say for a solid 5, 6, 7 years, we had a lot of halting of exam and civil money penalty problem in order to address bad data and a rescrub and a resubmit. I think at this stage in the game that has improved, and now for the most part we can go into an exam with a level of expectations that are met on a consistent basis. One other thing that we try to do for regulatory burden where it's appropriate to have both a compliance exam and an MLCI exam, we try to merge those as one exam and try to work that as consistently as we can with one exam. Unfortunately, as we get into scheduling of MLCI, we need to meet what those scheduling times are. We have found that we can get in and strictly do an MLCI exam when necessary at a quicker clip than doing it as a combined compliance exam. So we try to be cognizant of the regulatory burden to the licensee where applicable and where appropriate. There are times that we can meet that. There are times that we simply can't because of scheduling or because of timing or because it's just time to get in there and to do it.
When you say, just before we move off of the originations, I assume it's originations in Massachusetts. I would assume,
yes,
first of all.
yes.
Yeah. And then in terms of assessment area, could you give a little color of why the assessment area is different for, and I know that there's a lot of entities on here, the banks know how the assessment area works. Credit unions might have an idea, but not as well versed, considering that they have field of membership and things like that. Why is the non-depository so different?
Well, I could go by conjecture, and Mayte has history with it as well, and she please contribute. She will. She may know, but I'm going to assume that the activity within the industry of a mortgage lender is never controlled by a defined geography.
Right.
That if a mortgage loan originator could, and they're situated in Boston and could originate a second home in the Berkshires or on the Cape, they're going to originate that loan. And I think when, and I do know in the early fight, as an opposition to the law, it was, you really can't apply this to us. It doesn't work like that, because we don't take deposits. We don't have a defined area to receive deposits by a branch network. So therefore we can't lend within that network. So this was a very simple solution that said, okay, if a mortgage loan originator or a mortgage lender licensed in the Commonwealth was willing to do business anywhere in the Commonwealth, and certainly be paid for that business, then we could use that as a simple tool as an assessment area and give, which is in their benefit under the structures of the examination. If they can figure out a program to take access to government programming and use a network that they have throughout the Commonwealth to take advantage of that, then it's going to be to their benefit.
That's correct, Kevin. I think you hit it right on the mark that number one, non-depository mortgage lenders are pretty much able to set up shop anywhere in the state, in anywhere in the country. So they subject to licensing requirements, of course. But also the key piece is the deposit taking activity, which really governs assessment area delineation for banks. When you have a branch or ATM that takes in deposits, there's the requirement under CRA obviously to return those deposits in the form of credit. So, but like explained earlier by Kevin, a lot of these discussions about applying CRA to mortgage lenders was from back earlier in the 80s and continued through the 90s, late 80s and then 90s, which ultimately culminated during the 2007 foreclosure crisis, just to make sure that the CRA-like responsibilities would also be carried over. So a lot of industry dynamics going on, but the assessment area delineation in Massachusetts obviously allows the mortgage lenders to really have an entire Commonwealth, the entire state as a community investment opportunity, because the whole state is an opportunity for them to partner, to engage organizations in ways to donate. And so it's different than for banks that have to stick to that assessment area concentration.
Thanks, Mike.
Great. And then Kevin, and then I think we'll get to Francisco has some further questions, but just to kind of tie that together. So in terms of the non-bank space, that is the space where you see a lot of entities that don't necessarily have a physical footprint, like a physical location. How do those exams normally go for those non-bank originators? And I assume you also license entities that are on the non-bank space but don't necessarily originate any loans. Do you have any? Are they pulled into your law in any way whatsoever, or are they a separate entity?
If they're not originating greater than the 50 loans, then they wouldn't fall within the bucket of.
Right. So it's origination is the key. Yeah.
Correct. And yes, recognizing there is usually, for mortgage lenders, if they're licensed within the Commonwealth, there's usually a branch, some degree, prior to the pandemic, a physical branch presence that they do have. So we have physical space to go and examine books and records and whatnot. So that it's not like that doesn't exist at all. In some instances, for national lenders that are licensed in Massachusetts and doing greater than the 50, you may find that they don't physically have a branch location, but we will still take the responsibility to examine books and records where we can. The rest of the examination takes place just like any other of our examinations do, taking advantage of where we know that loans are being originated and who is originating them, and tracking the data in which we can find as a result of that. There is no inconsistency with regard to that. And a final thing on the assessment area that I can, for those lenders that we see with satisfactory or high satisfactory, these are people that are organizations, our companies, our licensees that have enthusiastically supported this concept, and they have leveraged that to their betterment and have used all of the resources available and thrive in this space. They do particularly well with mass housing partnership, and with FHA and with other design product that they design as a portfolio product, or partner with a bank with a portfolio product, that they're very creative and are very successful. So we like to look at those SATs and high SATs to see what they're doing, because when we hear from industry, well, I'm not really sure what it is that I can do to do better in this space, particularly on the lending test, and we give them examples of things that we have seen from other exams where they have gotten a SAT or a high SAT and said that these are the kinds of opportunities that are made available to you.
Great. I think I'm going to turn over to Francisco for his next question. Thank you, guys.
Yeah, thank you. And Mayte, thank you so much for talking a little bit about how you differentiate between larger institutions and smaller institutions, how you apply different criteria and as part of the examination, whether it be the assessment area or some of their outreach activities, because that's important. We've got some institutions here in Illinois that are, multi-billion plus in size, and we've got some smaller institutions. We've got some credit unions that are under 100,000 in size. So that's something that we're trying to take a close look at to make sure that as we apply this state CRA, because it is required that we apply it to every institution, that we take all those things into account. For our banks, they have some familiarity with CRA compliance. They've got some history because they've had to provide some of that detail to their federal regulators and their counterparts, whether it be the FDIC or the Federal Reserve. So they've got some experience there. It's for the other two groups, the mortgage lenders. They don't have a lot of experience with them, and certainly for credit unions, they don't have a lot of experience. But I'm pleased you hinted and you held out that there are a number of institutions, some of those smaller institutions that may not have a lot of lending patterns that they can rely on, really are able to highlight all of the activity, all the good activity that they do to try and do, whether it be community lending or financial literacy or outreach activities, to highlight the benefits that they provide. So I believe that we have a lot of smaller institutions in Illinois that also will provide some sort of exemplary kind of active and actions that they are taking right now within the state of Illinois. Many of them are very focused in making sure that they're serving their members as far as credit unions, or their customers as far as a bank. And they do that because they're looking at a long-term objective, which is that long-term objective of being self-sustaining and growing and making sure that they're responsive to their membership and to their clients. So I think we're going to find a lot of positive results there. But nonetheless, it's still a little bit scary for credit unions who don't have that experience of having to deal with this CRA compliance at the federal level as banks do. So if you could talk a little bit about how you work with your federal counterparts, how you interact with them. We know that for our state banks, they have an interaction already with our federal counterparts, but for our credit unions here in Illinois, they don't have that same corollary. And we know that the NCUA doesn't implement a CRA compliance because there's kind of a certain spirit of members helping members that every credit union adheres to. But if you can talk a little bit about how you work with your federal counterparts, that'd be very helpful.
Excellent question. It's always interesting because I always say that the team over at the Massachusetts Division of Banks that supervises CRA really needs to wear different hats, because we do have the bank side CRA, which is with our federal counterparts. And then we also have the CRA for credit unions, which obviously it's just us. I always say it's just us. We don't have the ability to partner on resources. So in NCUA, as you mentioned, Francisco, does not implement the CRA on the federal side. So we're pretty much, the Massachusetts CRA applies independently, and we do apply it to all of our credit unions that meet the asset size that I provided. And by the way, I incorporated that into the chat box because I know there was a question about, you know, how is it that we apply the, and we consider whether we consider the capacity of the institution and sophistication to serve LMI, but it's really based on asset size, and that table applies for both the banks and it applies also for the credit unions. On the bank side, obviously, when we partner with our FDIC or is the Federal Reserve, there's a lot of scheduling that's involved, and our team of examiners really need to be at the same level of expertise as the federal agencies because, you know, we are doing exams jointly with the FDIC. We issue the same PE with the FDIC. It's a joint report. It is not two separate reports. It's not two separate public evaluations or public disclosures. With any institution that's subject to the FDIC CRA will get one report from Massachusetts, and that will represent both the Massachusetts rating as well as the federal rating. With the Federal Reserve, Massachusetts does not have the same joint agreement. We do it concurrently. Concurrently means we both are on site at that particular bank. And we may be sharing data and information with the Federal Reserve in Boston, but we are issuing two separate public disclosures. We align ourselves to ensure this, you know, efficiencies, and we're reasonable with our approach to ensure there's not disparities between one regulator and the other. But I have to say is very efficient with the FDIC because there's one public disclosure. The scheduling is a public scheduling. Again, every quarter we issue the new institutions that are going to be subject to the CRA exam, and that with the FDIC is pretty much coincides with ours for our region, Massachusetts institutions. So, you know, there's a lot of coordination, Francisco, that takes place when we do these exams together. We need to be able to be, you know, very familiar with any changes in the regulation with the FAQs on the federal side, because there's often questions to both federal as well as state examiners on how this is going to impact whatever component is going to impact and how is it going to impact their institutions. So we get calls from our banks and we coordinate with the FDIC to have a joint call together so that there's no separate calls where there may be different information. That's, again, how it works on the coordination aspect with both the FDIC and the Federal Reserve. I will say something that also Massachusetts is different within its regulation is that we are able to assess a rating of high satisfactory, whereas on the federal side, it goes from satisfactory to outstanding. There's not a high satisfactory rating on the federal side. So our credit unions obviously receive that benefit. We basically carry out the exams fully independent, and we basically, again, concentrate on the income of that member and the type of credit union that it is and how expensive it is, so that we know whether we're going to use a large exam or a smaller. If it's a credit union, we're still following the asset threshold. If it's small credit union, it's just the lending test. But if it's a medium size or a larger, they're going through the 3 layers.
I want to emphasize that that it's really helpful to hear you share your thoughts and how you conduct your examination, because we certainly are going to be able to learn from your first step in this area. So what I heard is that you're able to coordinate with your federal partners, thereby reducing the regulatory burden on your institution, and that's something that should be welcome, especially for banks. so that even though that examination is done jointly, at least they know that they're going to be able. The examination takes place at one time as opposed to multiple times, where multiple interruptions, their operations or administration, or just in the delivery of their product and service to their community. So that's welcome to hear as well. So those are the things that we certainly want to try and incorporate here. And we appreciate that. As I mentioned, for banks, they've already had some history, and they may have staff available. For some of our other institutions, the mortgage lenders as well as our credit unions, they don't have an infrastructure currently in place that is able to gather the data, that has it readily available. So it's going to be a little bit more of a steeper learning curve for us here. And we're going to definitely try and continue talking with you and others to make sure that we're doing that as effectively as possible. So that was very helpful from that perspective. And I think I'm going to do is I'm going to turn it over to, let's see, do we need to, is there something else? No, okay, yeah. Chasse, I think you had a couple more questions you wanted to ask right now.
Yeah, and I think before we move on to this last piece, before we go into kind of more Illinois-centric things, Kevin, I know that there isn't a federal counterpart on the CRA, but something that we just opened up the possibility, and maybe you could talk about on the safety and soundness side. Obviously, states have coordinated with examinations on non-bank mortgage lenders. Now that Illinois is a nascent partner here, does your law allow for coordination with other states potentially, similar to how you coordinate with the federal folks?
Illinois, come on in, the water's fine. There is nothing precluding that, and it's something that we have thought about. As you know, there are coordinated systems that are being developed for multi-state mortgage examinations, which we have not tried to attach any MLCI to anything like that because it just is overwhelming. Now, I want to give Illinois, I think, some optimism by way of what our growing pains were and what we lived through that I don't think you necessarily will suffer with. And that is, in Massachusetts, less than 50% of the mortgage origination is from Massachusetts-centric companies. The majority of that are from national companies. So they're your loan depots, your guaranteed rates, your Quickens, your Fairways, that have all been subject to MLCI. So this is not going to come as a foreign concept now that they've been doing it in Massachusetts for 12 years. So I'm hoping whatever the hiccups and the growing pains that we may have suffered in the early, in the 2009s, 2010s, everyone by way of national lenders has become a lot more comfortable with this. And should more states adopt non-depository CRA, this would be a great concept to reduce burden and to align resources and add another element of coordinated supervision.
Thank you, Kevin, and we appreciate you guys as always in our conversations as we roll this out. I think I want to go before we go to the Illinois side of this, and I know we're running up on time as well. Is just what are some of the new things? What are you looking at currently right now, Mayte and Kevin? Just are there things you're considering right now? Maybe you can't talk about all of them, but just things right now in the CRA space that you're seeing.
Well, I can start. So a couple of things, when I was first introduced by the secretary, there was a mention about the OB Connect and the fact that we use that portal as an industry outreach mechanism. We're really trying to utilize that, especially with the COVID crisis, to remind our community banks and our community financial institutions and mortgage lenders that now more than ever, there are opportunities to think of CRA and think of how to make a difference, whether that is through a lending program or through a small business loan program, because CRA obviously also looks at small business lending, just like the federal side. And to think about the communities that are surrounding branches or institutions or a community where there's a lot of lending activity, because there are opportunities out there. So we're using that vehicle to tell the industry and to highlight these examples that are out there, to talk about ways to do that in first-time homeownership classes, financial literacy, foreclosure prevention initiatives, donations that have to do with low moderate income organizations, even at schools, providing credit for life fairs, which is financial literacy classes for students at schools. So there's a huge gamut of options. And so we are using that portal. That's a public portal that we're utilizing. Anyone can go right on our website to have some ideas on what we've covered under CRA. And so if you ask me, one of the things that we're doing is really utilizing that as an outreach vehicle to the industry, so that we can still communicate and keep them moving, align the CRA, thinking of CRA like opportunities. We're also thinking about CRA modernization, because obviously it's been discussed. It was so much of a heated discussion over the last year before COVID hit. And then gradually it went to the Federal Reserve, and we're still waiting for the results of the commentary that the Federal Reserve issued. But we do know, obviously, when we have a state CRA, you got to keep an eye on everything that's happening on the federal side for industry consistency. So we don't know what's going to happen 6 months from now, but we do know there's a lot of discussion about modernizing CRA, about clarifying activities that qualify, about looking at fintech type of platforms and seeing how they can potentially be subject to CRA as well. So in Massachusetts, through my team, we're really keeping a close eye on that as well. And being part of discussions with our federal counterparts to make sure that our own institutions are providing input as well at our level as a state regulator. So again, it's a lot of outreach right now, but also a lot of time for also to learn about what's going on with CRA modernization.
Great. Kevin, would you like to add anything? Or
Yeah, Mayte touched on a lot of it. I came to some degree as the secretary introduced me. I have a background that had come from representing the industry during a lot of this period, and I still do a lot of outreach and training and work within industry to keep them compliant, as I do an outreach with a lot of community groups to try to get them the funding through our Chapter 206 grant program. We're doing a pilot program currently right now on financial literacy that we're right in the midst of. So I am very encouraging to all of my industry colleagues that I have worked with for 20 years, that tells them if the division can figure out the money part and figure out how to coordinate it and to provide it, and the division can go and do financial training and first-time homebuyer program, and we can do all of that, then I think the industry can easily pick up their end of the bargain and do their part. And oh, by the way, get CRA credit for doing it. So this has been a long road to sort of get to real good compliance, but I think 12 years in, I think opportunities are presenting themselves that mortgage companies are really figuring it out, and where they can are thriving in this space.
great. Thank you so much, Kevin and Mayte. And let me thank you just so much for all of your questions, or all of your conversations and all of your guidance, both now and as we're going forward. I know we really appreciate it here. I think I'm gonna switch over before we wrap up here, and I just want to answer some general points here and kind of give a roadmap, and Director Menchaca and I can kind of go over. So you heard Massachusetts, you heard what they're doing, and kind of how our process is going to roll out, so that you guys are able to understand how the implementation is going to work, as well as are able to give comment and questions so that they can be heard as we go forward. So first of all, this is not going to be the only CRA related event that we are going to have this summer. This is just a kickoff to a series of events, and those will be very much focused on, and I know we haven't done that much on this call, but those are going to be specifically focused on questions and answers and that kind of component, and bringing back comment so that we can have a larger conversation about what, you know, different groups are thinking, community organizations, different industries. This kickoff event, which has well over 500 people on the call. We thought it was good to bring everybody in to kind of explain what we had seen from Massachusetts, and then kind of kick off a conversation where we can have more in-depth conversation before we get through the rule process. I also wanted to mention that we look forward to a lot of public comment and public questions, as well as things that are submitted. We are currently working on a part of our website that will receive questions related to public comment on CRA in general, but also just individual questions from industry as we go down this process. That should be available relatively soon. As soon as it is, everyone participated today, as well as other folks in throughout the industry and the community will have access to that and get notified, so that if you have specific burning questions, whether that was something Massachusetts said or something that we said or something else that you'd read somewhere, that we're able to get that information so we can continue. We don't have the specific timeline on the events yet. We are working that through right now, and a lot of those will be specific to groups that so that we can kind of control not who's there, but control kind of the types of questions that we're getting asked, so that we're able to get to as many folks as possible. Like I said in the beginning, the secretary really wanted this to be a transparent process and us to get as much content as possible, because as we've said, and as you heard on this call, this is about as big of a project as anything that the financial industry regulatory agencies on IDFPR has ever done. So we want to make sure that we're communicating our steps as we go forward. Turn it over to Francisco. He has additional questions or comments.
So I'll echo a little bit of what Director Rehwinkel mentioned here, but I wanted to just go back to some of the comments I heard Mayte and Kevin, and they talked a little bit about over this last year, especially how financial institutions have an opportunity to address some of the apparent needs that have become evident over this last year, especially after 10 years ago after the crisis, especially over this last year. So for some of you, you may know, but if not, I'll mention here now, and Mayte, Kevin, you may be aware of this, but here in Illinois, at the same time that we signed the Illinois CRA compliance, the governor also signed the PLPA, the Predatory Loan Prevention Act. And what that does is cap a consumer lending rate at 36%. And something that surfaced as part of that legislation was that one of the consumer groups was, as they advocated for that legislation, highlighted that approximately $500 million is paid in fees and interest to high-cost lenders. So for those institutions that are out there now, the depository institutions, if you kind of think about that, that's $500 million that potentially might be well served in establishing new depository accounts, new savings accounts that may be used as deposits for home ownership, and maybe in some wealth creation or asset building opportunities. And it's up to us as financial institutions to think about ways that we might be able to create those either financial literacy or coaching opportunities with that market that previously used high-cost lenders. And many of those might be our own customers now, and for whatever reason they opted to use a high-cost lender. And this might be an opportunity for you to take a look at that. So, I just wanted to highlight that there's a lot of changing opportunities that have taken place, and it's really a dynamic opportunity you have to take a look at, and what makes sense for your institution and for your members and for your clients that's gonna make a difference as we kind of take a look at kind of the delivery of CRA compliance. So I just wanted to highlight that was something that reminded me after Mayte and Kevin talked a little bit, and just to echo just a little bit of what Director Rehwinkel talked a little bit about, and that this is one of the first steps of various steps that we will take. Not only will we have these types of town hall meetings to get your input, to get all the folks that are out there listening to us now, we do want your input. As Chasse mentioned, there will be an opportunity to share your input via electronic email, but also these town halls will get a chance to kind of have a little bit different dialogue. And what that really means is that nothing is set in stone. We've heard from experts in Massachusetts as to what they do and how they do things. We're gonna rely on the kind of the groundwork that they've already set for us. We're gonna hopefully build on what they've already set for us. And if there's ways to improve that, we're gonna try and do that. We're gonna try and make sure that we address maybe some of the wrinkles that they have identified, and they'll share with us and how we might be able to address them now. But that's a whole part of the whole rulemaking process. And we want to make sure we get as much input as possible from all of you out there, and so that as we roll out that rulemaking process, because that's how it's going to be effective. The expectation that the legislature and the governor wants is that we effectively administer and implement this law, and that's what our intent is. And in order for us to be able to do that, is we've got to make sure that you understand what the metrics are going to look like and what the expectations are, and so that we can all make sure that we deliver on what the expectation is to our communities across the state of Illinois. So I believe that the Illinois State CRA tide is going to raise all boats across the state, and I believe that what the work that we continue to do here now is going to be hopefully an example for other states that they consider state CRA compliance, to make sure that they address the needs of their specific state, but of their specific communities as well. So from my perspective, we look forward to continue working with you all, look forward to hearing from you, and my phone is available, my email is available, and I've spoken with a few of you already. I'm looking forward to continue to speak with many of you going forward. I know that Chasse is always available. He's on his phone all the time talking to his constituents, and he's very active. And so, I also want to recognize Director Rehwinkel for taking the lead role in getting us to make sure that we had this communication here today, and others. So thank you very much for that, Chasse. And I want to thank everybody for being in the audience and listening to what we have to say, because this is just the first step for all of us.
Yeah, and I want to calm some folks that I know that we've gotten some questions in the chat, and there are others, and maybe people are worried that they're not going to get their specific question answered. Do not worry. We are having specific events on questions and answered pieces, and we will also be accepting written comments and stuff. This was more of a kickoff type item. I have been trying to record some of your just get down some of your questions. But if you feel like you're worried that you don't have a specific answer on the nitty gritty of what you want or have a piece of discussion, our office is open. We would like to receive your questions. And as soon as the just public comment part of the website is also up, everybody on this will get a message about that process. We will have our folks making sure that they're getting their comments in, and that we're looking at them. So do not worry. This is not the be all and last event on the schedule. This is just the beginning, and we look forward to further conversations with both the industry and community groups and also legislators that help pass this legislation to make sure we're implementing this in the way that is most effective for Illinois. So I think with that, I want to just thank our panelists. Thank you so much, Massachusetts. We're very happy to have you here, and we're sorry that we're sending colder weather your way. But we very much thank you for the process, and thank you for participating today.
You're welcome.
Well, thank you so much for having us.
Well, with that, guys, I think we're gonna wrap up slightly early. But again, if you have questions, feel free to shoot us, and then we will also be reaching out throughout this process, and look forward to this further conversation. Thank you so much today, and Chris, I think we're all set.